This edition is devoted to savings and investing, and when you are a saver and when you're an investor, and what's the difference between the two anyway. I want to talk about being a saver first, because you should be a saver before you're an investor. And what is the concept when I say that saving and investing are completely different? What is the difference? A saver is putting money in things that if you put in $1, when you take money out, you still have $1 plus whatever it earns. An investor is where you put money into something that you can lose some or all of the money you invest. There are some things that kind of cross the line and can confuse you, but let's start with the simplest concept about why savings is so important. And it's because if you don't have savings, you're not prepared for the oops in life. Because oops happen. All different types, sizes. Surveys show, no matter how the question is asked, seems to be roughly half of Americans cannot handle a simple financial hiccup in their lives. That's why having savings in an oops fund or emergency fund or whatever you want to call it is so very important. Savings accounts are best done at online banks where you'll earn much better interest than you would at a traditional bank or at a credit union. It's all about you thinking, what are the goals you want to achieve in your life, and setting aside money to make those goals happen. If you're starting from nothing, every pay period, slap $10 into a savings account. And it can be automatic right from the paycheck or automatically from your checking account at the bank or credit union into the savings account. So you build up some savings, and if you get really ambitious with having emergency funds, the standard book answer is that you save 6 months of living costs. What it would cost you if you had no pay at all coming in for 6 months. That's what you're supposed to save. But to go from saving nothing to 6 months is self-defeating. You end up feeling overwhelmed and you save nothing. So just start with saving $10 every pay period and let it build up and grow over time. And if you do have an oops or an emergency and it takes you off your goal and you have to spend what you've put aside in that savings account, you spend it because that's what it was there for in the first place. If you make a lot of money, you should look, instead of putting money in one of these online accounts, look at doing a tax-free money market account where you will be exempt from federal tax with the money you have. Because if you're a high income earner, you could be paying federal tax as high as 37%. And if you go in a municipal money market fund, tax-free money market fund, you won't be paying any of that federal tax on the money you have in that savings. And it's available to you just as readily as the money you have in an online savings account or at a credit union. This is about the concept of investing. Just because so many of us are put in a position where we're forced to make decisions and choices that we were never trained for. As I talk about back to basics, let me deal with some really simple concepts first. Investing is when you're putting money into things that in the short term at least, you could lose some, much, most, or all of what you invest. So I tend to be all about widely diversified investing where you could have ups and downs, but you're not going to lose everything. And over time, you should make a decent return on your money. Buying individual stocks is something a lot of people love to do, but that's where the risks are greater and the rewards potentially greater too. So what I'm about is diversifying, investing over time, and diversifying by what you invest in. Now, I want to start with the simplest windshield survey of putting money aside. The highest priority is to save for your own retirement. Highest priority. And I said save there. You save money to invest for your retirement. And for most of us, that means either an employer-provided plan or one we do on our own. For most of us, the way you really get this done is you see if your employer has any kind of retirement plan. Because most of us aren't just going to get around to it with the best of intentions. But if you set up with your employer and their 401k or equivalent plan to put money in every pay period, it happens on automatic pilot. And then I want you to step that up 1 cent every 6 months. And then steadily over time, you're not going to miss that 1 additional cent, but you'll steadily increase the amount of money you're putting aside for your future, and you'll be living on less than what you make. If you have an employer-provided plan, which roughly half of us do have access to, what's known as the 401k plan, you put money in a traditional 401k, you get a tax break for putting money in, and everything you have in it later when you retire is taxed 100%. Everything you contribute, everything it earns, you're taxed on all of it. The other flavor that's now available in a majority of 401k plans is the Roth 401k, where you put in after-tax dollars that grow tax-free and they're spent tax-free when you spend the money in retirement. 401ks have a big advantage usually because usually they will have an employer match of some amount of the money you put in. Most common match is 50% of what you contribute up to 6% of your pay. So if you put in 6%, the employer matches it with 3 and you got 9. But it can come in a variety of flavors. The 401k is the house. Then the question is how you furnish the house. That's where you invest the money. And my default option for you, if you're not really into this kind of stuff, is you'll almost certainly have something called a target retirement fund choice. The best place to start putting your money is what's known as a target retirement fund. They're really simple. You just pick the year closest to when you think you're going to retire, and you just slap all the money you're saving into that choice. Because what they do is the manager of the fund takes the money and divides it out based on how far you are from retirement. The younger you are, the further you are from retirement, the more you're really heavily in stocks. As you get closer and closer to retirement, it gets more conservative. Just put the money in and put it in that target retirement fund. And so if you go into, let's say, a 2050 fund, that means that the administrator of that 401k will continually change the mix of investments in it to deal with the proper level of risk for how many years you are away from retirement. When you're young, it'll be very heavily invested in stocks. When you're old, it'll be much less invested in stocks, but continue to have stocks in it because even when you retire, you may live another 30 years or so, potentially, and you need the stock exposure to outrun inflation. Now, let's say you're in the half of people that don't have an employer-provided retirement plan. Well, in that case, you can do something known as a traditional IRA or Roth IRA. I have a big bias in favor of the Roth IRA. Most people put it in so much money per paycheck, so much money per month. It's your account. It's your money. Now, as I mentioned, you can do a traditional where you get a tax break up front, but everything in that traditional IRA will be taxed in retirement, versus the Roth, which is after-tax money that goes in, but all the earnings, everything in it is yours tax-free in retirement. I especially prefer the Roth for anybody under 40 because there are lots of reasons to believe that tax rates are going to be higher in the future than they are now. And if you're over age 40, if you make a big paycheck, big money, you probably want to do a traditional 401k and get the upfront tax benefit, expecting that maybe even though tax rates will be higher overall later, you in retirement will have a lower income and be in a lower tax bracket. But if you're not a big income earner, even past age 40, you still want to be in a Roth IRA. And in the Roth, you'll have the same kind of choice I talked about in the 401k. You can go into a target retirement fund and let them handle the mix of investments, or you can pick and choose your own funds. Now, with a 401k, you don't get to pick who administers it. Your employer does. And there are low-cost plans, moderate-cost plans, and high-cost and extreme high-cost plans. Same thing's true with IRAs, except you get to pick where you invest your money. And I want you only in low-cost providers. What that means is you pay no commissions for the money you put in, and the management fee for managing your money is tiny each year. To give you a sense of this, if you go to a full commission stockbroker, a bank, or an insurance company, you're likely to pay commissions up front and ongoing massive expenses each year that with a bank or full commission stock brokerage could be above 1% of your money each year being eaten up, and with an insurance company above 2% of your money being eaten up. But as I've shared with you from time to time, the greatest indicator of how much money you're going to have down the road, it's strictly how much you paid in management fees. And so even if you choose to not do the target retirement fund and pick your own funds in an IRA, Roth IRA, the expenses involved with those funds front and center on what kind of wealth you'll have long term. So you start by putting money in, and then you stay on a path of putting more and more in. Don't blow your mind about how much money you have to save. Instead, you tackle it one paycheck at a time, one monthly contribution at a time, to where you get to where you're putting enough money aside to build comfort for your long term. And remember, the difference between investing and saving. Investing is when you're putting money into something that you may not see back all that you put in. Saving is where you put money into something like a savings account that you'll have more money left after a while than you started with. And in any circumstance, you will protect always what you put in. Savings accounts are parking spaces. Investing is for the long term. And money moves from saving to investing as you get out beyond 5 years and completely past 10 years as your horizon that you're putting money aside. The future eventually does show up, so you better be prepared for it. I want you to lower the level of anxiety you feel about money and instead increase the amount of financial security you have. I want you to win. The key to having financial security in your life is living on less than what you make.